Cloud software is one of the fastest growing categories. It offers great opportunities for discerning investors.
That's right. If you invested in Salesforce when the company went public in 2004, you returned 47 times your money over the next 20 years.
Whether you're a tech professional or an investor, how can you really tell what makes a great cloud software business?
Due to its significance, there is a tight link between DBNR and a company valuation multiples.
What are the red flags to watch out for? What metrics should you keep a close eye on?
A great tool to evaluate the trade-off of growth versus profit is the Rule of 40. By the end of this video, you'll be able to spot the next big cloud software winners, and we'll share critical free research tools we regularly use.
We have several invaluable market intelligence tools that help determine the category leaders, to name a few.
So stay tuned for that.
Hey there, I'm Stephanie, tech veteran, product leader, and creator.
And I'm Bertrand, founder of App Economy Insights.
Mark Andreessen's 2011 essay about why software is eating the world still resonates today, and his prediction has become our reality. Today, tech giants compose roughly a quarter of the S&P 500 and have significantly influenced market returns over the last decade.
Gartner projects cloud services to grow by 22% this year and reach nearly $600 billion. The SaaS category is the largest, making up a third of the spending.
Cloud software stocks are currently out of favor. To illustrate, the WisdomTree Cloud Computing ETF is 55% off its 2021 peak.
And these businesses are growing at a slower pace in a challenging macro environment. But on the positive side, we are now far from the inflated 2021 valuations following the rapid rise of interest rates. Lower valuations are great for new investors, but the challenge is to identify defensible moats in a category known for its relatively low barrier to entry. What makes a software business good or bad? What indicators should be on your checklist before investing?
So now that we've set the stage, let's dive into the 7 key traits you must look for. Understanding these traits will not only help you make better investment decisions, but also avoid potential pitfalls. Revenue growth, operating leverage, retention and expansion, sales efficiency, capital efficiency, category leaders, and skin in the game. Let's get into it.
Stock performance is fundamentally tied to future earnings, which is what the business can return to shareholders over time. While valuation multiples can be volatile, the actual engine driving long-term investment performance is the underlying business. Earnings growth comes from 2 main avenues: revenue growth, how much money comes in the door, and margin expansion, the portion of revenue that remains as profit.
But here's the catch. Profitability has its limits. The real game changers are companies that consistently grow their revenues over a very long time. If you're a long-term investor, the duration of growth is more important than the speed. As companies expand, their revenue growth inevitably moderates due to the sheer magnitude of the revenue base. This deceleration is a given. The key is understanding its context. Like, is the revenue reoccurring? Has growth been consistent? And can it be extrapolated over time? Did growth reaccelerate in the past? Does the current trend appear sustainable? And is growth coming from price, product, or customer increase?
Consider Paycom Software, a SaaS entity specialized in human capital management for small and medium-sized businesses. We call them SMBs for short. An impressive 99% of its revenue is recurrent and bringing high predictability. The global pandemic impacted SMBs disproportionately, and it resulted in significant customer attrition through downsizing or closures. As a result, Paycom faced a revenue growth dip in early 2020. Yet, their consistent 30% growth rate in the 3 years preceding the pandemic hinted at a possible bounce back to pre-COVID levels, which indeed materialized. Now, a word of caution. Even companies with stellar track records can fail and see their business falter. Overall, getting context on the nature of the revenue alongside current influencing factors remains paramount.
Now let's talk about operating leverage. In a previous video, we discussed the various stages in the life of a company. Many software companies strategically reinvest into the business by design in the early stages, playing the long game and spending aggressively on customer acquisition because they know the return on investment is going to pay off over several years thanks to reliable subscription revenue. Operating leverage happens when revenue grows faster than operating expenses, leading to expanding profit.
A great tool to evaluate the trade-off of growth versus profit is the Rule of 40. This rule means that a software company's growth rate and profit margin, when added together, should be more than 40%. When we mention the rule of 40 and the profit margin component, it's worth noting that not all investors expect the same thing. Some use the free cash flow margin, some use the operating margin.
Many software businesses aggressively use stock-based compensation, or SBC, particularly in sales and engineering teams. And we discussed the pros and cons of SBC in a dedicated video. In short, SBC is a non-cash expense, so using free cash flow can be misleading. We prefer using non-adjusted margins that include the impact of SBC.
Now, take cybersecurity giant CrowdStrike and its nearly $3 billion annual recurring revenue, or ARR for short. Despite its large run rate, revenue is still growing 37% year over year. Even though CrowdStrike has an operating loss in its latest quarter ending in July, the trend of its operating margin since its IPO tells a different story. CrowdStrike has steadily improved its GAAP operating margin and is on the cusp of turning profitable. We care less about what the margins are today and more about what they could look like in the future.
Over time, some customers pay more for services, some scale back their usage, and some just leave altogether. And so as a result, analyzing past cohorts of customers is critical. It shows in two specific metrics: retention and expansion.
First, the dollar-based net retention, or DBNR for short, is the best metric to evaluate customer loyalty and product value. It measures the revenue retained from existing customers over time, accounting for upsells, downgrades, and churn. A DBNR over 100% means the company could grow its revenue even without adding new customers. DBNR often goes by net revenue retention rate, or NRR. Some definitions might vary slightly, so keep that in mind.
And dollar-based net expansion, or DBNE, highlights the product's stickiness and increasing value to the user base. And it focuses specifically on the growth in revenue from existing customers, primarily through upsells or cross-sells. A value over 100% indicates that current customers are purchasing more services or products. An expansion metric is helpful to evaluate the success of a multi-product strategy and see if customers spend more over time. But the retention metric is a far superior performance indicator for long-term because it includes the impact of churn. And speaking of churn, it's the rate of customer departure, and it's absolutely essential for subscription-based industries. You should always prioritize metrics that include churn when evaluating SaaS businesses. A top-tier DBNR should be a key factor for SaaS investments. It's a tangible way to assess the sustainability and relevance of a product for its customers.
So let's take Snowflake, for example, boasting a market-leading 142% retention. Keep in mind, it will normalize over time, just like revenue growth, as the business scales. Few exceed a 120% retention rate. Due to its significance, there is a tight link between DBNR and a company valuation multiples. Beware of cheaper SaaS stocks. Like most things in life, you often get what you pay for.
Before we dive into the next 4 key traits to watch, be sure to hit that subscribe button so we can keep bringing you content and help you on your tech, business, and investing journey. Software companies often face criticism for directing the lion's share of revenue towards sales and marketing. Selling $1 for 90 cents might pump up revenue growth, but it isn't a sustainable business. Hence, understanding the underlying economics becomes essential. To evaluate the sales efficiency, we want to look at the CAC payback period.
I came across this concept as an executive in the gaming industry working on free-to-play games. Video game publishers spend money on ads to generate downloads. The CAC is the customer acquisition cost, and the LTV is the lifetime value of a customer, total they will spend over time. Companies can improve the LTV through upselling, cross-selling, or enhancing the product experience.
Right, and as long as the LTV is more than the CAC, the business will be profitable at scale. The CAC payback period, expressed in months, illustrates how many months it would take to recoup the investment in sales and marketing based on the current revenue run rate. A quick recoupment often points to a solid product market fit. And if you'd like to learn more about how to calculate the CAC payback period for public software companies, we left a link in the video description.
Let's look at Viva, a company particularly efficient at acquiring new customers, recouping its CAC in under 7 months. It's a favorable trait coming from its focus on the life science industry. Before dismissing a company for excessive sales and marketing spending, evaluate its payback period. If payback is below 24 months and management has good visibility on future revenue, it's probably money well spent.
Next, we want to evaluate the capital efficiency. Now that the interest-free era is behind us, cash flow has become even more critical. There are two main aspects to consider. First, the balance sheet. Does the company have more cash than debt? And if not, how many years would it take to clear its debt? Warren Buffett likes to find companies that can pay off their debt in less than 4 years. Why? Businesses with loads of debt may show that their business lacks a competitive advantage. And it also means that the business has no margin of safety looking forward. Next, cash flow margins. Is the business generating cash from operations? If so, it provides a margin of safety, enabling the company to finance its growth organically.
And again, many software businesses lean heavily on SBC. While this means no cash is exiting the company, shareholders face dilution. So considering the free cash flow after deducting SBC becomes essential.
Take Atlassian, a company with exceptional free cash flow margin. However, the business remains unprofitable. That's it. Atlassian has a robust balance sheet with a significant net cash position and generates a ton of cash every quarter. While existing shareholders do get diluted, the company's enterprise value improves as the business builds up its cash reserve.
Ultimately, we want to look beyond the surface level profitability. Positive cash flow is more critical than profitability to give a company optionality, be it through opportunistic M&A or weathering a downturn, but watch out for SBC.
All right, now, how do you pinpoint the top players in a software category? It's impossible to be well-versed in all types of B2B software. So how do you identify category leaders outside of your circle of competence? Well, we have several invaluable market intelligence tools that help determine the category leaders. To name a few, Gartner offers research and analysis on IT businesses, and their Magic Quadrant and Hype Cycle highlight a B2B software business's competitive position. Forrester provides sector-specific reports with Wave reports giving insights into B2B software market. IDC focuses on market research for IT, telecommunications, and consumer tech. DB Engines ranks database management systems. It helps understand the popularity and the trends of databases in the software sector. And G2 is a peer-to-peer review platform that gives first-hand software and services experiences. It offers a perspective on user satisfaction and software effectiveness.
These platforms serve as an excellent starting point, but keep in mind they have blind spots, limitations, and potential biases. It's best to multiply your sources of information. If there are other tools you like to use, share them with us in the comment section.
Let's take the example of the Customer Relationship Management category, or CRM for short. We previously discussed Salesforce, a stalwart focused on enterprise customers. In addition, there is another crucial player in this category focused on SMBs, and it's called HubSpot. Like Salesforce, HubSpot makes most of its revenue from subscriptions. However, the company is at a much earlier stage in its life cycle, growing north of 20% while not yet profitable. And if we look at the G2 grid for CRM, Salesforce and HubSpot, they stand out, outpacing competitors in market presence and customer satisfaction. Monday sales CRM is like a distant third.
The core takeaway here, if you find a business that struggles to be among the top 5 in its core category, why bother? Success is not guaranteed in investing, even if you select the best performers, but at least you're stacking the deck in your favor. Recognizing customers and developers' preferences is crucial since they evangelize these tools within their organizations.
All right, finally, we have leadership. Beyond quantitative KPIs, it's also super important to assess the people in charge. To evaluate the management team, consider these questions. Is the founding team still involved? Are they still invested in the company? Are there signs of a strong leadership culture?
In an ideal world, you would be able to answer yes to all these questions. Research by Bain & Company over 25 years reveals that companies with active founding members outperform others by 3.1x. Such companies excel at maintaining sustained profitable growth. The rationale: founders are committed for the long term, they are mission-driven, and they are willing to do what it takes.
Like Charlie Munger emphasized, having the right ownership mindset demands the right motivation, and that usually comes from high insider ownership. So watch out for leadership teams who still own a lot of stock.
Platforms like Glassdoor or Comparably, where employees review their organizations, offer insights into a company's culture. Stellar reviews can help attract and retain talent, especially in competitive markets like here in the San Francisco Bay Area. History shows that how employees praise their company might be a more compelling investment factor than PE ratios or free cash flow margins or any other financial metric. This is a conclusion reached by Fortune after reviewing the performance of companies considered top employers. After reviewing years of performance from Glassdoor's best places to work, I've actually reached the same conclusion.
Evaluating software companies requires a multifaceted approach. I mean, there's only so much you can learn in a spreadsheet, right? A simple glance at the financials is just not going to cut it. So use a blend of quantitative KPIs and qualitative insights, and investors can make informed decisions ensuring that they back not just a business with strong numbers, but one with superior product, a sustainable vision, and a motivated team at its helm. So drop a comment below with the cloud stock that you are currently keeping an eye on.
And don't forget, the most important part of an investing process is to understand who you are as an investor. So check out our video about the 6 types of investors and find what strategy matches your goals.